Many investors who are setting up their own retirement plans are confronted with the decision of how to allocate their assets in order to optimize their long-term return on investment without exposing their investments to excessive risks. On the one hand, stocks are volatile and relatively risky since economic downturns often reduce their prices for up to a decade at a time. During times of economic recovery, however, they grow faster and yield a better return on investment. On the other hand, bonds are more stable and relatively safe since interest rates tend to be less subject to fluctuations. Compared to stocks, however, they grow slower and yield a lower return on investment. One popular rule of thumb for this asset allocation decision is called the 100 minus age rule. This rule states that the percentage of an investor's portfolio that should be invested in stocks should be 100 minus their age. Since many people are living longer and since the rates of return on low-risk investments have been relatively low in recent decades, there are many experts who believe that this rule should be changed to 120 minus age. However, for the purpose of this video, it will be assumed that the investor is following the original 100 minus age rule. Most experts agree that the investment portfolio should be gradually adjusted over the course of one's life. Specifically, a younger person has time to wait for their stocks to recover from any potential economic downturns, and so they should be more heavily invested in stocks. Since an older person will be needing their portfolio relatively sooner, they are less able to wait for a recovery after a downturn, and so they are advised to arrange the portfolio so that it is more heavily invested in lower-risk bonds and government debt. Suppose that an investor is older than 50 years old, and so their portfolio has more bonds than stocks, as shown in this diagram. This represents the recommended balance of stocks and bonds. During any given year, however, the fair market value of each of these two segments is subject to change based on the fluctuation in the stock, bond, and money markets. For example, the stock market could be performing very well, and in this case, the fair market value of the stocks will rise higher, while the bonds might remain relatively stable. In this case, the desired age-based balance is lost, and if left alone, this could cause the portfolio to become overly exposed to risk. To remedy this, it is common practice to rebalance the portfolio annually by selling some of the stocks and buying more bonds, thereby locking in the gains and maintaining the desired level of risk. Another possible scenario could be that the bond market is performing poorly, and in this case, the fair market value of the bonds will fall, while the stocks might remain relatively stable. In this case, the desired age-based balance is lost, and if left alone, this could cause the portfolio to become overly exposed to risk. To remedy this, it is common practice to rebalance the portfolio annually by selling some of the stocks and buying more bonds, thereby effectively buying them at a relatively low price and maintaining the desired level of risk. Now let us suppose that the stock market is experiencing a downturn, and in this case, the fair market value of the stocks will fall while the bonds might remain relatively stable. Again, the desired age-based balance is lost, and if left alone, this could cause the portfolio to be overly invested in bonds, causing it to grow too slowly. To correct this, it is common practice to rebalance the portfolio annually by selling some of the bonds and buying more stocks, thereby effectively buying stocks at a relatively low price and maintaining the desired level of risk. Now let us consider the scenario whereby the bond market is experiencing a rise in fair market values, and in this case the fair market value of the bonds will rise while the stocks might remain relatively stable. Once again, the desired age-based balance is lost, and if left alone, this could cause the portfolio to be overly invested in bonds, causing it to grow too slowly. To correct this, it is common practice to rebalance the portfolio annually by selling some of the bonds and buying more stocks, thereby locking in the gains and maintaining the desired level of risk. In all cases, it is a good habit to periodically review and rebalance the portfolio, and by following the method outlined in this video, the investor will be automatically buying low and selling high, which will improve the overall long-term performance of the retirement portfolio.